Welcome to The Explainer. Today, we're jumping into the really fascinating and, yeah, pretty complex world of in-house finance. We're going to look at how these huge multinational companies move money around inside their own corporate family and the comprehensive rules that try to keep it all on the level.
So here's the big question, right? If a company's German branch lends, say, $1 billion to its Irish branch, who gets to decide the interest rate? And more importantly, how do we know that rate isn't just a clever way to shrink their tax bill? This is the puzzle we're going to solve today.
All right, so how are we going to tackle this? Here's our game plan. First, we'll look at why these rules are even a thing. Then, we'll get into the big idea that governs everything, the arm's length principle. After that, we'll see how tax authorities look past the labels to figure out what's really going on. Then we'll get practical, pricing some common deals, and we'll wrap up with a really interesting case, captive insurance.
The heart of the issue is actually pretty simple. A giant multinational company, an M&E, has basically total freedom to set whatever terms it wants for deals between its own divisions. They control the interest rate, the repayment terms, everything. But that kind of power, well, it creates a huge potential headache for tax authorities all over the world.
And that headache has a name: profit shifting. Imagine this. A company could have one of its branches in a country with high taxes pay a ridiculously high interest rate on a loan from another branch in a low tax haven. That high interest payment, poof, reduces the profit in the high tax country, which means a smaller tax bill. And that is the very thing these comprehensive OECD guidelines are designed to stop.
Okay, so if you can't trust the company's internal numbers, how do you police these deals? Well, tax authorities have a simple but really powerful idea that they use as their North Star. It's pretty much the bedrock of international tax, and it's called the arm's length principle. What this means, basically, is that companies inside the same group have to pretend they don't know each other. They have to deal with each other at arm's length, like total strangers haggling over a price in the open market. This principle is the ultimate litmus test for figuring out if an internal deal makes any commercial sense. Think of it like selling your house. If a stranger comes along, you're going to try to get the best market price, right? But what if your brother wants to buy it? You might give him a nice family discount. Well, the arm's length principle says, for tax purposes, you always have to charge the stranger price. Sorry, no family discounts allowed here. But it's not just about the price tag. Applying this principle means you have to go deeper. Tax authorities have to look past the fancy labels on the paperwork and figure out what a transaction really is. This whole process is called delineating the transaction. And check this out. This is a direct quote from the OECD's own guidelines. They are basically saying, look, we don't care if you call it a loan, a management fee, or a purchase of magic beans. We're going to tear it apart and look at the economic substance to decide what it really is. They are not messing around. So that leads to a really fundamental question. A parent company can send money to a subsidiary and call it a loan, which creates interest payments that are tax deductible. Or it could call it an equity investment, which is like buying shares, and that doesn't create a tax deduction. So how on earth do you tell the difference? Well, you have to look at the reality of the situation. The OECD lays out a kind of checklist. For example, does it have a fixed repayment date? A real loan almost always does. Is there a real legal obligation to pay interest? And maybe the biggest tell of all, could this company have gotten a similar loan from a real independent bank? If the answer is no way, that's a huge red flag that this might not be a loan after all.
So it really just boils down to this. A loan is debt. It has to be paid back, it has to have interest, and if the company goes bankrupt, the lenders get their money before the owners do. An equity contribution, on the other hand, is ownership. There's no repayment date, you get a return only if there are profits, and if things go south, the owners are the last ones to see a dime. Tax authorities are going to look at all the facts to see which of these two boxes the transaction actually fits in.
Okay, so now that we know how to figure out what a transaction actually is, let's put this into practice. We're going to look at how you'd price two super common things: internal company loans and financial guarantees. This is where it gets real. So first, we have to talk about this really interesting idea called implicit support. Just by being part of, say, the Apple or the Volkswagen family, a smaller company gets a kind of credit halo effect. Lenders just assume the big parent company won't let it fail. This benefit, which comes from just being part of the group, is considered free. No one has to pay for it. And that sets up the million-dollar question. If a subsidiary already gets this free halo effect, what's the extra value it gets when the parent company gives a formal, written, legally binding guarantee?
because that extra benefit is what the subsidiary should be paying a fair arm's-length price for. There's a pretty neat way to measure this called the yield approach. Let's say with just that implicit halo effect, a subsidiary would have to pay 5% interest on a bank loan. But with a formal guarantee from mom and dad, the bank says, okay, we'll give you a 3% rate. That 2% difference, that's the real tangible value of the guarantee. And that savings right there, that's the absolute most the subsidiary would ever be willing to pay for it. Any more than that, and they just take the 5% loan.
All right, for our last stop, let's look at one of the more sophisticated things you'll see out there, the captive insurer. This is when a huge multinational group decides to set up its very own in-house insurance company. So, a captive insurer's main job, sometimes its only job, is to insure the risks of its sister companies. Instead of paying massive premiums to some external insurance giant, the different operating companies in the group pay those premiums to their very own captive, which, you guessed it, is often set up in a country with very friendly tax laws. And here we go. This is the critical question. Is this a real, genuine insurance business, or is it just a fancy piggy bank, a slush fund to park cash somewhere with low taxes? For it to be legit, it has to walk, talk, and act like a real arm's-length insurance company. And the answer is a big, flashing yes. The OECD has a whole comprehensive checklist for this. A real captive has to actually pool and diversify different risks from across the entire group. It needs to be properly regulated and have enough capital to actually pay out claims. It needs skilled people running the show. But maybe most important of all, it has to face a real, genuine possibility of losing money if something bad happens, just like any other insurer on the planet. So the bottom line on captives is this. The whole setup has to involve a real transfer and pooling of risk. If all it's doing is taking money from one pocket and putting it in another to sit there as a rainy day fund without any real diversification, well, tax authorities are probably going to say that's not insurance at all. When you boil it all down, everything we've talked about today comes back to this one powerful idea. The arm's length principle isn't just about getting the price right. It's a comprehensive way of thinking that forces everyone to ignore the convenient labels and dig deep into the economic reality of what's actually happening inside a multinational group. And I'll leave you with a final thought to chew on. The whole principle of acting like a stranger is based on comparing internal deals to what outsiders would do. But as these global companies get more and more creative, inventing financial arrangements that strangers would never in a million years do with each other, how will you keep making that comparison? That's the big, evolving challenge for tax experts around the globe. Thanks for tuning in.